I welcome you all to the Manifested e-learning platform. We have been studying the topic mergers and acquisitions. We began by learning in our last session on how to value companies using the net asset value basis for the purposes of mergers and acquisitions. We said that valuing companies is a complex thing to do, and there are various methods that can be used to value companies for mergers and acquisitions purposes. Today we move to the second basis, which is the PE ratio basis. The price to earnings ratio, candidates, is a widely used and often intuitive valuation multiple in the context of mergers and acquisitions. It is a market-based approach that helps assess the relative value of a company's shares. And this basis, the PE ratio, expresses the relationship between a company's stock price and its earnings per share. And essentially, it tells you how much investors are willing to pay for each shilling of a company's earnings. Okay? And the PE ratio is calculated by dividing the market price per share by earnings per share. Market price per share over earnings per share. That's the formula. Now, the primary application of the PE ratio in mergers and acquisition is through what we call comparable company analysis. Comparable company analysis, and also the precedent transactions analysis. Comparable company analysis application is through one, comparable company analysis, and precedent transactions analysis. Let's first look at the comparable company analysis. Now, candidates, the first step when applying this in the comparable company analysis is to, first of all, identify comparables. The first step here is to identify comparables. The first step is to identify a group of publicly traded companies that are similar to the target company in terms of the industry, in terms of business model, size, growth prospects, and risk profile. Because these are often referred to as peer companies or comparables. You understand, candidates? So if you are to value company A, you look for companies similar to company A in terms of the size, in terms of the growth prospects, and so on. That is step number one. Then step number two is to gather data. Gather data. That is to mean collect financial data for the comparable companies, including their current stock prices, the earnings for at least 12 months or forward estimates. You understand? Look at the financials of the companies that you've chosen. If you are to compare company A, if you are to value company A, look for companies that are similar to company A, around say 5 companies. Gather data about the companies, their stock prices, their PEs, and all that. Make sure you have all the data. Then step number 3 is to do what we call calculation of PE multiples. Calculate PE multiples. calculate the PE ratio for each comparable company. Then determine the implied multiple. Determine the implied multiple. Determine the implied multiple. Determine the implied multiple. That is to mean that you analyze the PE ratios of the comparable companies. Because first of all, let me demonstrate here what I mean. If you are to value company A, valuation, for example, if you are to value company A, first of all, identify comparables. And how do you identify the comparables? You take a group of publicly traded companies that are similar to the target company. This is the target company. Take, for example, company B, C, D, E. Step number 1, identify the comparables, the peer companies. Then gather data about these comparables. Gather data, collect financial data for the comparable companies, including their current stock prices, their earnings, and so on. You can take trailing months, for example, 12 trailing months, the 12 months before. Get the data, stock prices, the PE ratios, and all that. Then the third step is to calculate PE multiples. Calculate PE multiples. Calculate the PE ratio for each comparable company. Each comparable company, calculate the PE ratio. Each company. PE ratio. Calculate the PE ratio for each company. Then determine the implied comparable. Determine the implied comparable. Analyze the PE ratio of the comparable companies, and you might take an average. After determining this PE ratio, take an average. If there are 4, get the total of the 4, divide by 4. That is an average. You understand? You take an average, you take a median, or even weighted average, or select a multiple that best reflects the target company's specific characteristics relative to its peers. Then you just apply it to the target. Step number 5, apply it to the target. After calculating the average ratio, the average PE ratio, you apply that ratio to the target. Apply the chosen PE multiple to the target company's earnings, okay, to arrive at the estimated equity base. To arrive at the estimated equity base. And how does that happen? The target equity value will then be equal to the target company's net income, target company's net income times the multiple that has been selected. Okay? The selected PE multiple times the selected multiple. That would give you the target equity value. The target equity value. Now to get the target share price, this is the target equity value. To get the target share price, to calculate the target share price. To calculate the target share price, candidates, you get the product of the target company's EPS times the selected PE ratio. Target company's EPS. You multiply the target company's EPS by the selected PE multiple. Selected multiple. You see that? Yes. That is how to apply the comparable company analysis. You understand? Yes. Then I mentioned there are two applications, candidates. There are two applications. The primary application of the PE ratio in mergers and acquisitions is through the comparable company analysis, precedent transaction analysis. The precedent, this is number one. Number two is the precedent analysis. The precedent transaction analysis. The procedure is first of all to identify past deals. Step number one, identify past deals. Here you have to research recent M&A transactions involving companies similar to the target. Then you extract multiples. Extract multiples. Step number two, when doing the precedent transaction analysis, step number two is to extract multiples. For each past transaction, determine the implied PE multiple at which the deal was completed. Do you understand? Yes. So candidates, we are assuming here one wants to apply PE ratio under the precedent transaction analysis approach. Step number one, identify past deals. You want to value target A. One, identify previous deals, the M and A deals, previous deals. It could be deal 1, deal 2, deal 3, deal 4. You look at what the valuation that was done in the past. Identify past deals. Research recent mergers and acquisition transactions involving companies similar to target A. Then extract the multiples. If there was a deal that was carried out last year or 2 years before or 6 months before or last month, you extract the multiples. And how do you extract the multiples? For each past transaction, determine the implied PE multiple at which the deal was completed, because this is in the past. This is in the past. What was the multiple at which the deal was completed? That is the second stage. Then you just analyze in step number 3 and apply. Analyze and apply. Analyze these historical PE multiples to derive a range or specific multiple applicable to the current target. And candidate, this is another method. So you can apply the PE ratio using comparable company analysis or precedent. Precedent means before, prior transaction analysis. You analyze past M&A deals, mergers and acquisitions that have been done in the past. Precedent, before, prior, all right? And candidates, this method is particularly useful because it reflects actual prices paid for control of a company, often incorporating control premium and so on. Precedent transaction analysis. Precedent transaction analysis. And candidates, there are two types of PE ratios that may be used. We are studying PE ratio basis, candidates. There are types of PE ratio that may be used. Of PE ratios that may be used. The first type is called trailing PE. One, trailing PE ratio. Trailing PE ratio. What do we mean by trailing? Now, trailing PE ratio uses the actual earnings from the past 12 months. Okay? Actual earnings, uses actual earnings from the past 12 months. PTM, the past 12 months, the last 12 months. And this is based on concrete audited data, but might not reflect current or future trends. That is one type of PE ratio that may be used. The second type of PE ratio that may be used is forward PE. Forward PE ratio. Forward PE. This one uses analysts. Okay? Uses analysts forecasted earnings for the next. These are forecasts of an analyst. Okay? Forecasted earnings for the next 12 months. This is next 12 months. This is past 12 months. The second one is the next 12 months. And this is a forward-looking. It is forward-looking and captures expected growth, but it relies on subjective estimates, which can be inaccurate. Type of PE ratio that may be used is what we call normalized PE. Normalized PE adjusts to remove the impact of one-time events or non-recurring items. For example, asset sales, the large written write-offs, like the company's sustainable. So there are three types of ratios that may be used in mergers and acquisitions. The trailing PE ratio, number one. Number two, the forward PE ratio. Number two, the normalized PE ratio. In closing, let us analyze the pros and cons. Pros and cons. What are the advantages of this basis? The first advantage is that this method is simple. Let me say simple. One, simple and intuitive. Simple and intuitive. The PE ratio is easy to understand and calculate, making it a common metric for initial screening and discussion. Number two, it's market oriented. The method is market oriented. That is to mean it reflects the current market sentiment, how investors value earnings in a particular industry. Three, benchmarking. Benchmarking. It allows for quick comparison of a target against its peers or industry averages. Of course, you've seen how when using the precedent transaction analysis and also the comparable company analysis, there is that aspect of benchmarking. It allows for quick comparison of a target company's valuation against its peers or industry averages. Number four, there is a focus on profitability. That is number three. Focus on profitability. Focus on profitability. Focus on profitability. The PE ratio basis directly links valuation to the company's bottom line. The company's bottom line profitability, which is a key driver for many acquirers. 5, widely available data. Widely available data. For public comparables, PE ratios and earnings data are easily accessible. They are what? They are easily accessible because remember we talked about gathering data in comparable company analysis, where you collect financial data for comparable companies, including their current stock prices and earnings. The data is widely available, and that is an advantage. Then what are the limitations? What are the limitations of the PE ratio in valuation of mergers and acquisition? The first disadvantage of this method is reliance on comparables. Reliance on comparables is a drawback. Reliance on. Now, how is reliance on comparables a disadvantage? It is a disadvantage because the accuracy of the PE ratio valuation heavily depends on finding true comparable companies. And minor differences in business models, geographical markets, growth strategies, or even competitive advantages can significantly distort the comparison. Two, it ignores structure. This method ignores the capital structure. The PE ratio is an equity multiple and does not account for differences in the debt levels between companies. And a company with a high debt might have a lower PE, but it also carries higher financial risk, which isn't directly reflected in this basis. And the enterprise value multiples are often preferred for mergers and acquisitions as they are capital structure neutral. Understand? There's also the problem with low earnings. We have also another disadvantage associated with the problem with negative or low earnings. Problem with negative or low. Problem associated with the negative or low earnings. How is that a drawback? It is a drawback because candidates, for companies with no earnings or negative earnings, or what we call losses, or those that are highly volatile, with highly volatile earnings, the PE ratio is meaningless or highly unstable, and this makes it unsuitable for early stage high growth companies that are not yet profitable. 5. This method, number 4, does not account for growth rate. Does not account for growth rates of the comparables. Does not account for growth rate of comparable rates. For comparables. Now, while a high PE often implies high growth expectations, the ratio itself does not explicitly factor in the rate of growth, because a company with a lower PE might be a better investment if its growth rate is significantly higher than a peer with a higher PE. You understand? Yes, you do understand what I'm talking about. Moving on to the 5th disadvantage is susceptibility to accounting distortion. Susceptibility to accounting distortion. Susceptibility to accounting distortion. Earnings can be influenced by accounting policies. It can be influenced by non-recurring items and management discretion, potentially leading to misleading PE ratio. So candidates, these are 5 disadvantages. You can go on and mention synergies. It doesn't reflect synergies. Doesn't reflect synergies. Does not reflect synergies. The PE ratio basis for valuation of mergers does not reflect synergies. The PE multiple, candidates, derived from standalone comparable companies or past transactions typically doesn't fully capture the unique synergies, like cost savings, like revenue enhancements that a specific acquirer might realize from a merger. You understand? And these synergies often justify paying a premium. So that's all for our today's lesson on valuation of firms or shares for M&A purposes. Today we focused on the PE ratio. We've seen how the PE ratio can be applied. There are two ways. One is through comparable company analysis. You can carry out comparable analysis. We've seen, I've given you the stages. Then there is also the precedent transaction analysis. I've explained how that is done. Then we've identified two types of PE ratios. The trailing PE ratio, which captures the past 12 months. Then there is the forward PE ratio, the next 12 months. Then you have the normalized PE ratio. Then we've gone ahead to summarize the advantages and limitations of PE ratio as a basis for valuation of firms for merger and acquisition purposes. And in concluding, candidates, I need to mention that the PE ratio is a valuable tool in mergers and acquisition analysis, primarily for its ease of use and its ability to provide a quick relative valuation. However, due to its limitations, particularly its sensitivity to comparables and inability to account for capital structure or negative earnings, it is rarely used in isolation. It is rarely used in isolation. That is to mean this method is used in conjunction with the other methods of valuation of shares. And instead it forms again a part of a broader valuation framework, often combined with other fundamental or foundational approaches or methods like the discounted cash flow and also the other multiples to provide a comprehensive and a more robust valuation range for the target company. So thank you for choosing to study with us. We will continue to learn how to value targets for or companies for mergers and acquisition purposes. There are more other methods. We take a break at that. At a later stage, we are going to work out an illustrative example. Most likely or preferably, we are going to work out a past CASNEB paper testing on how to value a target using the PE ratio basis. Bye.